Welcome to The Explainer. Today, we're going to tackle risk management in banking. We've taken a pretty dense exam guide and boiled it down to the absolute essentials you need to know, all in a clear visual format to really help you nail the topic.
Okay, let's start with this right here. This one idea is the absolute heart of banking. It's simple, right? If you want to make more money, you have to be willing to take on more risk. It's a constant balancing act, and managing that trade-off, well, that's the whole game.
So, here's how we're going to break it all down for you. We've split this into 5 key sections. We'll kick things off with the basics, then get into the governance structure, the actual risk process, the key people involved, and we'll wrap up with the major risks banks are up against.
All right, first things first. Before we can dive deep, we've got to be speaking the same language. So, let's lock in these foundational concepts because honestly, everything else is built on top of them.
Think of risk appetite as the bank's official comfort zone. It's a formal statement that basically says this is how much risk we're willing to stomach to hit our targets. And this isn't just some vague idea, It's a concrete framework that guides every major decision.
So, if risk appetite is the what, risk culture is the how. It's the personality of the bank when it comes to risk. And this part is absolutely critical. It has to come from the very top. A strong tone at the top is everything, because when you look at the biggest financial blowups, a bad risk culture is almost always the villain of the story.
Now this is super useful. This little matrix is a powerful decision-making tool, almost like a cheat sheet. If a risk could cause a lot of damage but probably won't happen, you transfer it, buy insurance. If it's high damage and high probability, you just don't do it, you avoid it. It's a really clear, logical playbook.
And when it comes to measuring risk, you've really got 2 main flavors. On one hand, you have the quantitative stuff. This is the pure science. You're using complex math and models to spit out a number. But on the other hand, you have the qualitative side, which is more of an art. How do you put a number on a bank's reputation? You can't. That's where you need expert judgment and experience.
Okay, so we've got the basic terms down. Now let's build on that and look at the governance framework. We're talking about the people and the structures that actually bring all this risk management theory to life.
This model is the absolute cornerstone of good governance. Think of it like this. The first line is the business itself. The folks making loans and trades. They own the risk. The second line is the oversight crew, like the risk and compliance departments, who set the rules of the road. And that third line? That's your independent assurance, the auditors who check to make sure the whole system is actually working. It's all about checks and balances.
And who's at the very top of this whole structure? The board of directors.
And here's the key takeaway. The buck stops with them, always. They can delegate the day-to-day work, sure, but they can never, ever delegate that ultimate responsibility for the risks the bank takes on.
Okay, we've talked about the concepts and the structure. So now, let's get our hands dirty and look at the actual step-by-step process for how you manage risk. This is the how-to part.
This 5-step loop you see here, this is the engine that drives the whole thing. First you find the risk, then you measure it, figure out how to reduce it, price it into your products, and then you watch it like a hawk. And it's not a one-time thing, it's a constant, never-ending cycle. So you might be asking, how do banks actually find these risks in the first place? Well, they have a whole toolkit. It's kind of like being a detective. They dig through old audit reports, analyze past losses, and even run what-if scenarios. They also track things called key risk indicators, which are like little alarm bells that warn them of trouble ahead.
And a huge part of measuring risk is something called stress testing. This is where you basically try to break the bank. In a simulation, of course. Regulators and banks will dream up these horrible but plausible crisis scenarios to answer one terrifying question. If our worst nightmare comes true, do we survive? It is, quite literally, a financial fire drill. So we've got the process down. Now, let's put some names and faces to these roles. This part is all about who's actually in charge of doing all the things we've just talked about. The central figure in this whole universe is the Chief Risk Officer, or CRO. This is a very senior executive, and their appointment has to be signed off by the board. But here's the most critical part of their job. They have a direct, unfiltered line to the board. That means the board hears about risk issues straight from the source, no sugarcoating.
The CRO is the head of the Risk Management Division, or RMD. You should think of this division as the central nervous system of the entire risk operation. It's the hub, the nucleus, and it's set up to be independent from the business, which is so important for keeping its analysis objective and free from conflicts of interest.
And overseeing all of this, you have 2 key committees.
It's easiest to think of it as strategy versus tactics. At the top, you have the boards committee. They're the strategists, focused on the big picture. Then you have the executive committee, led by the CRO. They're the tacticians, dealing with the nitty-gritty of risk management month to month.
All right, for our final section, let's zoom out. We're going to look at the main types of risks that keep bankers up at night and the huge web of global regulations that tries to keep everything in check.
And let's start with the big one, credit risk. This is the oldest and usually the largest risk a bank faces. To put it simply, it's the risk that someone who owes you money isn't going to pay you back. It's the most fundamental risk in all of banking.
Now, to manage risks like these on a global scale, regulators came up with the Basel Accords, and this timeline really tells a story. Basel I, way back in '88, was pretty simple. It was almost all about credit risk. Then, after a few crises, Basel II came along and made things more complex, adding in operational and market risks. And then, of course, the 2008 financial crisis happened, which gave us Basel III, a massive upgrade that seriously toughened capital rules and, for the first time ever, created global rules for liquidity.
And when you look at a national level, regulators get really specific. This list, for instance, from the Central Bank of Bangladesh, is a fantastic snapshot of a modern bank's risk universe. It goes way beyond just loans. You got everything from IT risk to money laundering on there. It's the whole shebang.
So we'll leave you with this final thought. A great risk management framework needs three things to work: good people, good processes, and good systems. But a chain is only as strong as its weakest link. So the question is, when the pressure is really on, which of those pillars do you think is the first to crack? And that wraps up our explainer. Thanks for watching.